Hello, everyone. Thanks for joining us today as we dive into a topic that's been on a lot of minds lately. Let's talk about the recent stock market drop. Many of you are probably feeling uneasy about your retirement accounts, and you're not alone. It's completely normal to feel anxious when you see your hard-earned savings take a sudden dip. After Labor Day, Wall Street returned in a sour mood, with markets opening sharply lower and closing in the red. The energy on the trading floor was tense, and investors everywhere felt the sting. This wasn't just a blip, it was a wake-up call that the market's mood has shifted. The sharp drop caught many off guard, serving as a stark reminder that markets can change direction quickly and without much warning. For 4 months, stocks climbed steadily, lulling investors into a sense of security. It's easy to get comfortable when the numbers keep going up, and optimism was running high. But as always, complacency is dangerous. Markets have a way of humbling us. Just when you think you figured it out, the unexpected happens, and reality sets in. This week's downturn is a reminder that volatility never disappears for long. Even in the best of times, the market's ups and downs are always lurking just beneath the surface, ready to reappear. The sell-off was triggered by a mix of economic worries, Fed uncertainty, political drama, and overvalued stocks, all boiling over at once. When these factors collide, it creates the perfect storm for a market correction. Global events and headlines can hit your portfolio fast, which is why preparation is key. In today's interconnected world, news from across the globe can impact your investments in a matter of minutes. Don't panic and sell. Instead, take a breath and focus on your long-term plan. Remember, market downturns are a normal part of investing, and staying calm is often the best strategy. Let's break down what's really going on and explore how you can navigate these turbulent times with confidence and a clear head. When you hear people talk about the market, it can sound like a mysterious, all-knowing force. But in reality, the market is just a way to describe the collective movement of certain key groups of stocks. These groups are tracked by what we call indexes, which act like scoreboards for the overall health of the economy. Most of the time, when news outlets or investors mention the market, they're referring to 3 main indexes: the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. Each one tells a slightly different story about what's happening in the world of business and finance. The Dow Jones tracks 30 of America's biggest and most influential companies. Think of it as a snapshot of the country's corporate giants. When the Dow drops, it usually means these industry leaders are facing challenges, which can ripple out to affect the broader economy. This week, the Dow fell over 300 points, a significant move that signals broad weakness among these top-tier companies. Such a drop often grabs headlines and can make investors nervous about what's coming next. The S&P 500, on the other hand, covers 500 large companies from a wide range of industries. It represents about 80% of the total value of the U.S. stock market, making it a more comprehensive measure of how the market as a whole is performing. Its nearly 1% drop this week shows that the pain wasn't limited to just a few sectors. It was felt across the board, affecting everything from banks to retailers to manufacturers. The Nasdaq is known for being tech-heavy, packed with thousands of innovation-driven stocks like Amazon, Alphabet, and other technology leaders. It's often seen as a barometer for the future of business and the pace of innovation. This week, the Nasdaq also fell about 1%, showing that even the high-flying tech sector isn't immune to market pressures. When tech stocks stumble, it can have an outsized impact on investor sentiment. When all 3 indexes fall together, it's not just a fluke or a problem with one industry, it's a sign of a market-wide sell-off. This kind of synchronized decline suggests that investors are worried about bigger issues affecting the entire economy. Investors are reacting to a mix of big-picture economic and political uncertainty, things like inflation, interest rates, global conflicts, or changes in government policy. These factors can make people nervous about the future, prompting them to pull back from the market. This kind of synchronized drop means the worries are bigger than any single company or sector. It's a collective move, as investors everywhere try to reduce their risk and protect their portfolios. When fear spreads, selling can become contagious, leading to even sharper declines as more people rush to get out. So why does this often happen in September? Let's take a closer look at why this month has a reputation for being especially rough for the markets. Is it a coincidence this happened in September? Not really. Historically, September is the worst month for stocks, Data backs up the so-called September effect. Fund managers return from summer, reassess portfolios, and often sell to lock in profits, triggering a wave of selling. Families also sell stocks to cover back-to-school and tuition expenses, adding to the pressure. Many companies release fiscal guidance, sometimes spooking investors. After months of gains, the market was primed for a pullback. Like a stretched rubber band, the snapback can be sharp. The combination of history and recent gains set the stage for this rough start. But there's more at play. Let's talk about rising yields. One big reason for the recent stock market sell-off? Rising Treasury yields in the bond market. This shift in yields is sending a powerful message to investors everywhere. And it's not just a blip on the radar, it's a signal that the financial landscape is changing in real time. When investors sell bonds, prices fall and yields rise. This week, yields on 10. And 30-year treasuries jump to multi-year highs. These aren't just numbers on a screen. They reflect a fundamental shift in how investors are thinking about risk, reward, and the future of the economy. Higher yields mean investors can get safer returns from government bonds, making stocks less attractive. Why take a risk on stocks when you can get a solid return from something as safe as a U.S. Treasury? This is a classic case of the risk-reward balance tilting in favor of bonds. As yields rise, some investors shift money from stocks to bonds, pushing stock prices down. This movement isn't just about numbers, it's about confidence. And right now, confidence is flowing toward the bond market. Higher yields also raise borrowing costs for companies, hurting future profits. When it costs more to borrow, companies may delay expansion, cut back on hiring, or even scale down investment in new projects. So, rising yields are a double whammy, offering safer alternatives for investors and making loans pricier for businesses. This combination can slow down economic growth and put pressure on corporate earnings. When you see headlines about yields, it's the bond market warning stocks that money is getting more expensive. It's a flashing signal that the era of ultra-low rates may be behind us, and that has ripple effects across the entire financial system. The days of easy, cheap borrowing may be ending. For years, low rates made it simple for everyone, from homebuyers to big corporations, to borrow money. Now that's changing, and it's making people nervous. This shift affects everything, from your mortgage rate to tech stock prices. Homebuyers may face higher monthly payments, and fast-growing companies that rely on cheap financing could see their stock values take a hit. The jump in yields forced investors to rethink stock values. Suddenly, the math changes, and what looked like a good deal yesterday might not look so great today. It was a major catalyst for this week's sell-off. The rapid rise in yields caught many off guard, triggering a wave of selling as investors scrambled to adjust their portfolios. But yields aren't the only factor. Let's talk about the Fed. The central bank's decisions on interest rates play a huge role in shaping these market moves. Enter the interest rate tug-of-war, where every move by the Fed can tip the balance between stocks and bonds and set the tone for what comes next in the markets. The Federal Reserve, or Fed, is at the center of market anxiety. The market's been hoping for a rate cut soon, which would boost stocks by lowering borrowing costs. But recent inflation data and upcoming jobs reports are muddying the waters. If the labor market looks too strong, the Fed may delay a rate cut, disappointing investors. Every economic report is now under a microscope for clues about the Fed's next move. The uncertainty is fueling volatility. The sell-off reflects fear that the hoped-for rate cut could be postponed. And that's not the only uncertainty. Politics are adding fuel to the fire. Political and legal uncertainty from Washington is rattling markets. A federal court struck down most of President Trump's global tariffs, creating confusion for companies involved in international trade. The legal battle isn't over, and businesses can't plan with so much up in the air. Meanwhile, a court hearing about the Fed's independence left investors uneasy. The Fed's ability to act without political interference is crucial for stability. All this legal and political drama adds risk, making U.S. assets look less attractive. Investors are now weighing not just earnings, but also court rulings and power struggles. This uncertainty can drive money out of stocks and into safer havens. The headlines from Washington can move billions in an instant. And this week, tech stocks felt the pain most. Let's see why. Tech stocks, especially the Magnificent Seven, led the market's decline. Amazon and Alphabet both dropped over 2% in a day, dragging down the S&P 500 and Nasdaq. The main issue: valuations got too high after a huge run-up. Rising yields make future tech profits less valuable, prompting investors to rethink what they'll pay. The market is shifting from growth at any price to demanding real profits and reasonable prices. This is a lesson in diversification. Don't get overexposed to a few high-flying stocks. Even the biggest companies aren't immune to market forces. Their fall shows just how much influence a handful of stocks have. But while stocks fell, some assets soared. Amid the market turmoil, gold shined, surging to a record high above $3,500 an ounce. Gold is a classic safe haven when investors are nervous about the economy or financial system. The rally is fueled by expectations of Fed rate cuts and a weaker dollar. Lower rates make gold more attractive compared to cash. Oil prices also rose, and Bitcoin continued its run as investors sought alternatives. The strong performance of gold and Bitcoin shows a clear demand for assets outside traditional markets. Investors aren't just hiding, they're reallocating to what they think will do better in uncertain times. Gold's record price is a vote of no confidence in the short-term outlook for stocks and bonds. It signals deep anxiety and a search for safety. So what should you do now? What does all this mean for your money? Don't panic. Stick to your long-term plan and avoid emotional decisions. If your portfolio is diversified and matches your goals, a week like this shouldn't derail you. These events impact your investments, mortgage rates, and even prices at the store. Understanding them helps you stay in control. The next few weeks are critical. Watch the jobs report and the Fed's meeting for clues about what's next. We're at a turning point, and the market's direction is uncertain. Review your financial plan and make sure you're not taking on too much risk. Build an emergency fund if you don't have one. Don't try to time the market. Invest consistently over time. Downturns are normal. Discipline and patience are key. Stay informed, stay diversified, and stay strong. You've got this.